Revenue recognition. Okay, might not sound like the most thrilling topic initially.
Huh. Maybe not top of everyone's list.
But think about it, it's basically the scoreboard for any company, right? How they count their wins.
Absolutely. It's fundamental.
And today, prompted by a request from our listener, the learner, we're jumping into this.
Our aim here isn't just to, talk accounting jargon. It's about understanding how companies actually track the value they create.
Exactly.
So this deep dive will break down the core ideas from that document. And what's really useful is how it compares the international standards, IFRS, with the U.S. ones, U.S. GAAP.
Right. And for you, the learner, we heard you want to get this quickly, thoroughly, but without getting bogged down.
Yep, we'll pull out the main nuggets for you, make it make sense.
Okay, let's dive in. The document kicks off with a core principle. Seems like it's the foundation for both IFRS and GAAP.
That's right. The absolute key idea under both systems is that revenue gets recognized when a company transfers the promised goods or services to the customer.
Okay, transfer of goods or services.
And crucially, it's for the amount the company expects to get in return for those goods or services. So it's linking revenue to actually delivering the value.
Got it. It's about the substance of the deal, not just, say, when an invoice goes out or cash arrives.
Precisely.
Now, the document lays out this 5-step model. Sounds like this is a practical how-to guide for applying that principle for both IFRS and GAAP.
Exactly. It's the framework. Very logical, actually.
Let's walk through it. Step 1, identify the contract with a customer. What actually counts as a contract here? It's not just any agreement, is it?
No, it needs to meet certain criteria. First, it has to be legally enforceable. Then you need to be able to identify each party's rights regarding the goods or services.
Okay.
Payment terms need to be clear. The contract also needs commercial substance, meaning it's expected to actually change the company's future cash flows.
Right, it has to be a real business deal.
And finally, and this is important, it must be probable that the company will actually collect the money it's entitled to under the contract. If all those boxes are ticked, then yes, you've got a contract for revenue recognition.
Okay, makes sense. You need that commercial reality and likelihood of getting paid.
Yeah.
So, contract identified. Step 2 is identifying the performance obligations. What are those exactly?
Performance obligations are basically the promises within that contract. A promise to transfer a distinct good or service to the customer.
Distinct.
Yeah, distinct is the key word. It means the customer can benefit from that good or service either on its own or, with other resources they already have access to.
Okay.
So it could be one single item like selling a widget. Or it could be a bundle of things, maybe goods and services together. If they're distinct, think about buying a new smartphone. The phone itself is one performance obligation. Maybe it comes with a 1-year warranty service. That could be another distinct performance obligation. You had to break the contract down into these individual promises.
Right, so it's about slicing the contract into its deliverable parts. Okay, step 3. Determine the transaction price. Now, you hinted earlier, it's about what the company expects to receive. So it's not always just the list price on the contract.
Exactly right. It's the amount of consideration, so payment, the company expects to be entitled to for fulfilling its promises.
Yeah.
It can be a fixed price, sure, but very often it includes variable amounts.
Variable consideration. Like what?
Things like discounts, rebates, refunds, credits, performance bonuses, incentives, even penalties. Stuff that depends on future events.
Oh, okay. So how do companies handle that uncertainty?
They have to estimate it.
Okay.
They look at the possibilities and estimate the variable amount. But, and the document stresses this, there's a constraint.
A constraint.
Yes. They can only include that estimated variable amount in the transaction price if it's highly probable that a significant reversal of the cumulative revenue recognized won't happen later when the uncertainty clears up.
Ah, okay. So you have to be pretty confident you'll actually get that amount before you count it as revenue. You can't be too optimistic.
That's the idea. It prevents overstating revenue early on. You need a solid basis for the estimate.
Makes sense. Okay, estimate made, constrained if necessary. Now, step 4. Allocate that transaction price to the performance obligations. If you have multiple promises, like the phone and the warranty, how do you split the total price between them?
Good question. The allocation is based on the relative standalone selling prices of each distinct good or service.
Standalone selling price.
Yeah, what the company would sell that specific item or service for separately on its own. So for the phone and warranty example, you'd figure out the price of the phone if sold alone and the price of the warranty if sold alone. Then you use the ratio of those standalone prices to allocate the total transaction price you determined in step 3. Each part gets its proportional share.
Got it. So each deliverable is assigned a value based on what it's worth individually. That feels fair.
It aims to reflect the economics of the transaction.
Right. And that leads us to the final step, step 5. Recognize revenue when or as the entity satisfies a performance obligation. This is the actual booking of the revenue. When does this happen?
This happens when the company transfers control of the promised good or service to the customer. That's the trigger.
Control. Okay.
And this transfer of control can happen either over time or at a specific point in time, depending on the nature of the performance obligation.
We'll dig into control and that timing difference more, I think. But first, something the document highlights is this alignment between IFRS and US GAAP. It wasn't always this way, was it?
Oh, definitely not. Historically, there were quite a few differences, which made comparing companies across borders tricky. But as the document points out, the standard setters, the IASB for IFRS and FASB for US GAAP, work together on this new revenue recognition standard, IFRS 15 and Topic 606 in the US.
And the goal was convergence.
Exactly. To create a common framework, improve comparability, provide more useful information. And this 5-step model is the result. The document calls this convergence a major improvement. It really is a big step forward.
That's huge for anyone analyzing international companies. So the core principles, the 5 steps, largely the same now.
Yes, largely converged. It simplifies things immensely.
But are there any lingering differences the document mentions, or areas where maybe the application differs slightly?
Well, the document does note that while the main standard is converged, there are still some specific scope exceptions. Certain types of contracts aren't covered by this main revenue standard because they have their own specific accounting rules.
Like what, for example?
Things like lease contracts, insurance contracts, financial instruments. Those follow separate guidance under both IFRS and GAAP. So the 5-step model applies to most typical contracts for goods and services, but you need to be aware of these specific carve-outs.
Okay, so the general engine is the same, but some specific vehicles have their own manuals.
Got it.
You mentioned control is the key for step 5 for when revenue is recognized. Can we unpack that concept a bit more? What does it mean for the customer to gain control?
Sure. Control, in this context, essentially means the customer has the ability to direct the use of that good or service.
Direct the use.
And importantly, to obtain substantially all of the remaining benefits from it. Can they decide how it's used? Can they stop others using it? Do the main economic benefits flow to them?
Okay.
Think about buying groceries. Once you pay and walk out of the store with your shopping bags, you control those groceries, right? You decide what to cook, when to eat them, who gets to share them. You get the benefit, the nourishment, the enjoyment. Control has transferred at that point.
Yep. That's a really clear everyday example. Okay, so control is key. Now, let's circle back to recognizing revenue over time versus at a point in time. What determines which it is?
The standard, and the document reflects this, lays out specific criteria for recognizing revenue over time. If any one of 3 criteria is met, then it's over time.
What are they?
Okay, first, if the customer simultaneously receives and consumes the benefits provided by the entity's performance as the entity performs. Think of like a monthly cleaning service. You benefit continuously as the cleaning happens each month.
Right, you get the value as it's delivered.
Second, if the entity's performance creates or enhances an asset, say, work in progress that the customer controls as the asset is created or enhanced, like building a custom piece of machinery on the customer's site. They control it as it's being built.
Okay.
And third, if the entity's performance doesn't create an asset with an alternative use to the entity, the entity has an enforceable right to payment for performance completed to date. This often applies to highly customized services or projects.
Okay, so if any of those apply, it's revenue over time. If not,
if none of those criteria are met, then revenue is recognized at the point in time when control does transfer. This is often when goods are delivered. The document mentions indicators like the customer having legal title, physical possession, accepted the asset, and having the significant risks and rewards of ownership. That grocery example is a point-in-time transfer.
That distinction is really helpful. Thanks. Yeah. Now, variable consideration, again, you mentioned estimating it, but with that highly probable constraint, how exactly do companies make that estimate? Is it just guesswork?
Not guesswork, no. The standard suggests 2 methods, and companies should use whichever one they expect to better predict the amount they'll actually be entitled to.
What are the methods?
One is the expected value method, basically a probability-weighted amount based on a range of possible outcomes. Good if you have lots of similar contracts.
Okay.
The other is the most likely amount method.
Yeah.
Just the single most likely amount in a range of possibilities. Might be better if there are only two possible outcomes, like getting a bonus or not.
And whichever method they use, that highly probable constraint still applies.
Absolutely. That constraint overrides everything. You estimate using expected value or most likely amount, but then you check. Is it highly probable that recognizing this amount now won't lead to a significant reversal later? Only if the answer is yes can you include it in the transaction price.
Got it. It's a crucial check. Now, the document also touched on contract costs. What's the story there? Costs to get or fulfill a contract.
Yeah, these are costs like, say, sales commissions paid to get a contract, or the direct costs of materials of labor used to actually fulfill the contract, like in a service agreement.
And how are they treated? Just expensed straight away?
Not necessarily. The document notes that some of these costs, specifically costs to obtain a contract that wouldn't have been incurred if the contract wasn't won, and costs to fulfill a contract, can be capitalized.
Capitalized, meaning put on the balance sheet as an asset.
Exactly. If they meet certain criteria, primarily that the company expects to recover those costs through the revenue generated by the contract. The idea is to match those costs with the revenue they help generate, rather than expensing them all up front. They get amortized or expensed over the period the related revenue is recognized.
Okay, so another matching principle type of idea. Finally, presentation. How does all this end up looking in the financial statements? What do companies need to tell us?
Transparency is key. The document stresses this. Companies need to disclose enough information so that users of the financial statements can understand the nature, amount, timing, and uncertainty of revenue and cash flows arising from contracts with customers.
So specifics.
Yes, things like breaking down revenue into meaningful categories, information about remaining performance obligations, details about significant judgments made especially around things like variable consideration or determining when control transfers. It's about giving a clear picture.
Right. More than just a single revenue number.
Much more. The disclosures are quite extensive under the new standard.
Wow, okay. This has been, well, actually a really interesting deep dive. It might seem technical, but you're right. It's core to understanding how a business really ticks financially.
It absolutely is.
We've gone through the core principle, that really practical 5-step model, which, thankfully, now largely bridges IFRS and US GAAP.
Big win there.
The crucial idea of control transfer, differentiating revenue over time versus point in time, navigating variable consideration, handling contract costs, and the importance of clear disclosure.
Yeah, quite a journey through the RevRec landscape. And hopefully for you, the learner, this gives you that solid, clear overview you were after without getting lost in the weeds.
Definitely. We tried to hit the key points from the document clearly.
Yeah.
So as you're processing all this, here's maybe a final thought to chew on.
Ooh, okay.
How might you interpret changes in a company's revenue recognition policies? If they tweak how or when they recognize revenue, even subtly, what could that signal about their business itself, or maybe their customer relationships, or even their financial pressures?
That's a good one. Policies aren't always static.
And maybe also, thinking about these principles, are there specific industries where you'd now suspect revenue recognition is particularly complex or subjective?
Yeah.
Where you'd really want to scrutinize the details?
Yeah, construction, software, long-term service contracts maybe. Lots to think about.
Exactly. Maybe take these ideas, grab some real company financial reports, and see how it plays out in practice. It really brings it to life.